Many retirees wonder whether traditional budgeting rules still apply in today's economy. In this video, we will explain how the 50-30-20 rule can still be a useful tool in 2025. Hi, I'm Andrew from Golden Age Financial. Welcome back to the channel. Today, we're looking at one of the most popular budgeting tools out there. It's called the 50-30-20 rule, and it's often used by people managing monthly spending. Even in retirement, it can be a helpful guide to organize expenses, make better decisions, and give you peace of mind. Let's start by breaking down what the rule actually means and how it is structured. The rule divides your after-tax income into three parts: 50% for needs, 30% for wants, and 20% for savings or debt repayment. Your needs include things like housing, food, insurance, and transportation, basically what you must pay to live safely and comfortably. Wants are the extra comforts. This could be dining out, travel, hobbies, or entertainment. In retirement, that might include golf or trips to see the grandkids. Finally, savings or debt covers things like paying down a credit card or growing your emergency fund. Even retirees benefit from this step. Let's talk about how the traditional 50-30-20 rule can be adjusted for people no longer working full-time. In retirement, you might not have a regular paycheck. Instead, income may come from Social Security, pensions, or withdrawals from savings. With fixed income, your needs category might take up more than 50%. That's okay. The rule is flexible. For some retirees, a 60-20-20 or 70-20-10 split might work better depending on medical costs and fixed expenses. The goal is not perfection. It's about creating clarity and stability so you can enjoy retirement without money stress. Let's look at where retirees typically spend their money each month based on recent reports. This chart shows the average breakdown of retiree spending in the United States as of 2025. As seen in the chart, housing and healthcare are often the biggest expense categories. These usually fall under the needs section of the rule. Travel, hobbies, and gifts for family often fall under wants. These may vary from month to month. Some retirees still save regularly. For example, setting aside money for future medical bills or to leave a legacy. Now let's go over some things to watch out for when using this rule in retirement. One common mistake is treating the rule as a strict requirement. It should guide your decisions, not limit your lifestyle. Another mistake is underestimating healthcare costs. These can increase with age and should be carefully considered in your monthly needs. Some also forget to factor in seasonal spending like holidays, travel, or taxes. Planning for those up front helps avoid surprises. This graph shows how inflation has affected retiree expenses leading up to 2025. Being flexible and building in buffers can help protect your retirement lifestyle from rising costs. If you're curious how to apply this rule, here are some starting points. Start by reviewing your monthly expenses. Compare them to your current income from retirement sources. Estimate how much of your spending goes to needs, wants, and savings. You don't need exact numbers to start. Use the categories in this rule to see where you might want to make changes over time. Most importantly, use what works for you. If peace of mind improves, the rule is doing its job. Before we close, here are a few helpful reminders. This video is for educational purposes only. For personal financial decisions, please speak with a qualified financial planner or advisor you trust. If you found this helpful, we would love to hear your thoughts in the comments below. And if you'd like more clear guidance on retirement finances, please hit subscribe and follow our channel.